Explore the intricate landscape of global finance, where trends, innovations, and economic forces converge to shape the world's economic landscape. Financial markets are centralized or decentralized platforms where financial instruments such as stocks, bonds, commodities, and currencies are traded. They allow the efficient allocation of capital, risk management, and price discovery. The main participants in financial markets include investors, issuers, brokers, dealers, and regulators. They interact to facilitate the exchange of financial assets and manage risks associated with market volatility. Financial markets can be categorized into different types, such as equity markets, bonds, fixed income markets, derivatives markets, and foreign exchange markets, each with its own unique characteristics and trading mechanisms. The primary functions of financial markets include capital formation, liquidity provision, and price discovery, which are essential for the proper functioning of the economy. Financial markets facilitate the efficient allocation of capital, allowing businesses to raise funds for growth and expansion. They determine the fair value of financial assets through the interaction of supply and demand, providing transparent pricing. Financial markets offer a range of instruments for investors to manage and hedge various risks, such as interest rate, currency, and commodity price fluctuations. Efficient financial markets provide liquidity, enabling the easy conversion of assets into cash, facilitating economic transactions. Stock markets are centralized exchanges where publicly traded companies' shares are bought and sold. They facilitate price discovery, capital formation, and economic growth. The most well-known stock exchanges include the New York Stock Exchange and Nasdaq. Stock prices fluctuate based on supply and demand, reflecting investors' perceptions of a company's future performance. Trading occurs through a variety of order types and mechanisms, overseen by regulatory bodies to ensure fairness and transparency. Bond markets are financial marketplaces where debt securities, or bonds, are traded. Bonds are debt instruments issued by governments, corporations, and other entities to raise capital. Investors can purchase bonds and receive regular interest payments, known as the bond's yield. Bond markets play a crucial role in providing financing for various economic activities and allow investors to diversify their portfolios. The performance of bond markets can significantly impact interest rates, inflation, and overall economic stability. Gold is one of the most actively traded commodities, with its price fluctuating based on supply, demand, and various economic factors. Crude oil and refined petroleum products like gasoline and diesel are essential commodities that drive global economic activity. Commodities like wheat, corn, soybeans, and livestock are crucial for food production and consumption worldwide. Foreign exchange, Forex or FX, markets facilitate the trading of one currency for another. These global, decentralized markets determine the relative values of different currencies, which fluctuate constantly due to factors like interest rates, economic performance, and political stability. Forex trading involves the simultaneous buying of one currency and selling of another, with the goal of profiting from changes in their exchange rate. Major players include banks, investment funds, and individual traders. Derivatives markets trade a wide range of complex financial instruments, including options, futures, swaps, and other derivatives that allow investors to manage risk and speculate on price movements. Derivatives markets are characterized by high speed, high-volume trading, often driven by sophisticated algorithms and computer-based trading strategies that exploit small price movements. Derivatives markets are interconnected globally, with leading exchanges and over-the-counter trading centers located in major financial capitals around the world. Market capitalization. Market indices provide a snapshot of overall market performance by tracking a basket of representative stocks. They serve as benchmarks for measuring the health and trends of financial markets. The S&P 500 is a broad index of 500 large U.S. companies. The Nasdaq Composite Index includes over 3,000 stocks listed on the Nasdaq exchange. The Dow Jones Industrial Average is an index of 30 large, publicly traded U.S. companies. The FTSE 100 includes the 100 largest companies listed on the London Stock Exchange. Trades are executed through electronic order matching systems that pair buy and sell orders based on price, time, and other factors. Financial markets utilize electronic trading platforms, which provide real-time quotes, time quotes, order management, and trade execution capabilities. Investors can place various order types, such as market orders, limit orders, and stop orders, to manage their trade execution. An order to buy or sell a security at the best available market price, executed immediately, is known as a market order. A limit order is an order to buy or sell a security at a specific price or better, executed when the market reaches the specified price. A stop order becomes a market order once the security reaches a certain price, useful for limiting losses or securing gains. A stop limit order becomes a limit order once the security reaches a certain price, allowing more control over the execution price. The efficient market hypothesis states that asset prices fully reflect all available information, making it impossible to consistently outperform the market. Informational efficiency refers to the degree to which asset prices reflect all relevant information. This affects the ability to generate excess returns through trading. Market efficiency has important implications for investment strategies, portfolio management, and the role of fundamental and technical analysis. Fundamental analysis focuses on assessing a company's underlying financial health, including its assets, liabilities, revenue, and earnings. Analyzing macroeconomic factors and industry conditions helps to understand a company's competitive position and growth prospects. Using fundamental analysis to identify undervalued or mispriced stocks can inform investment decisions. Qualitative assessment involves evaluating a company's management, products, services, and long-term viability. Technical analysis focuses on identifying recurring chart patterns, such as support and resistance levels, that can indicate future price movements. Various technical indicators and oscillators, like moving averages and RSI, are used to analyze market trends and momentum. Technical analysts rely on historical price and volume data to make trading decisions, using a systematic, quantitative approach. Proponents of technical analysis believe it can help predict future price movements based on past market behavior. Higher potential returns are usually accompanied by higher levels of risk. Investors must balance their risk tolerance with their desired returns. Metrics like standard deviation and beta can quantify the level of risk associated with an investment or asset. Diversification, hedging, and other strategies can help manage and mitigate risks. Investors expect higher returns from riskier assets to compensate them for taking on additional risk. Investing in a variety of asset classes helps mitigate the impact of any single investment's volatility. A diversified portfolio can provide higher returns over the long term by capturing growth across different market sectors. Combining uncorrelated assets can smooth out the ups and downs of market fluctuations. Growth investing focuses on companies with strong potential for future earnings growth, aiming to capitalize on rising stock prices. Value investing seeks out undervalued stocks trading at a discount to their intrinsic worth, with the goal of long-term appreciation. Income investing targets investments that generate regular cash flow, such as dividend-paying stocks and fixed-income securities. Governments and agencies enact laws and policies to oversee financial markets and protect investors. Financial institutions must adhere to regulations to operate legally and avoid penalties. Regulatory bodies monitor market activity and enforce rules to maintain stability and fairness. Central banks are responsible for implementing monetary policy, regulating the money supply, and maintaining financial stability within an economy. Key tools include adjusting interest rates, reserve requirements, and open market operations to influence inflation, employment, and economic growth. Many central banks have adopted an explicit inflation target, typically around 2%, as their primary objective for monetary policy. Central banks are generally granted a high degree of independence to implement policies, but are also accountable to governments and the public. Governments use fiscal policy to influence the economy through spending, taxation, and borrowing. This involves complex decision-making to balance objectives like growth, inflation, and employment. Expansionary fiscal policy, such as tax cuts or increased government spending, can stimulate the economy and boost employment. Contractionary policy, like tax hikes or spending cuts, may slow growth but control inflation. Fiscal policy decisions often have widespread impacts on citizens and can spark public debate, protests, or political changes. Governments must weigh public sentiment when designing policies. Economic indicators are statistical metrics that provide insights into the health and performance of an economy. They help policymakers, businesses, and investors make informed decisions by tracking key economic factors such as GDP, inflation, employment, and consumer spending. Rapid and unsustainable increases in asset prices, driven by speculation and irrational exuberance, can lead to economic bubbles. When a bubble inevitably bursts, it can trigger a sudden and severe market crash, causing widespread economic disruption and hardship.